Greetings, fellow investors. In today's video, I would say, more vague and a bit more theoretical because I would want to talk about investing in general, not about specific stocks or specific events and my analysis on these events, but more general. What is investing in its definition and what are the main, I would say, ways to invest? Because here's the thing. In recent years, investing has become increasingly more popular and regular people are starting to invest more and more. The question is, are these people really understanding what investing actually means? And what's the, I would say, foundation of investing? My guess is no, they have not. And they are missing one very, very important piece in their puzzle, and this is general principles. So let's start. First things first, the best question, what is investing? And actually, answer to this question is, I would say, rather complex because, well, in theory, in like academic theory, investing would be venture where one pools his resources in some asset which will generate either interest income or dividends or rent or any similar passive income out from that capital. So in that sense, investing will be only in places like bank deposits, bonds and coupon payments, and stocks in form of dividends or real estate in form of rent or something similar. In this definition, long-term asset growth wouldn't be part of investing, that would be speculation. But here's the truth. If you look at successful long-term investors and successful money managers, in recent decades, absolute majority of them are making money from long-term capital gains rather than dividend payments. And so I would say this definition is outdated for decades. But before, like 40, 50 years ago, this definition had a valid point because we had different corporate structure. Because up, I would say, until 70s or 80s, most companies valued their, not valued, but paid their shareholders in form of dividends. That was a reasonable thing to do because if you made profit, you had to reward your shareholders. So you paid dividends. But then tax laws changed and it became way more profitable for companies not to pay dividends but to retain profits and buy back shares from the stock market so they would increase shareholders' value. And you see in the last decades the same thing. Most companies reward their senior executives, their employees and their shareholders with share buybacks. So that means they have less shares which are floating, and those who are shareholders have automatically higher shareholders value. So this is the way to go. And in this corporate world, the previous definition of investing isn't working. But I would say that's not the point. And I will also say that it's not actually that important whether we are naming our venture as investing, speculation, trading or whatnot, because what's important is our goal. Our goal is to have steady, predictable, long-term gains that I would say, can count on, if we can count on anything in this life. But that's the definition, and how we actually call it, whether we are investors or traders, I would say this is not that important. So here's my thing. According to, I would say, old school definition of investing, none of us are investors, but that doesn't matter because everything what matters is how profitable actually we are. So now we will gather to phase number 2 and we will assess what are the key ways how to invest. And this actually, in comparison to previous definition, actually is rather important because the way how you invest, way how you are pulling your money matters a lot. And here it's better for you not to confuse the ways how to do it. Firstly, this is trading and speculation. And this is purely making money on price fluctuations. And this video is about investing, so I wouldn't venture there. But that's the niche where people make money, but in most part, most people lose money. So for that, you need to have good trading strategy and you have to have really good risk management. If you have that, you have a chance. If you are not, you don't stand a chance. But this topic will be discussed in different videos and we will leave it at there. And now we will talk about main, I would say, 2 brackets of investing, and one of them is passive investing. In passive investing, I would say actually it's really simple. You are not picking best investments yourself, you are mostly investing in ready products and in established strategies. For instance, everyone knows strategy where you are simply buying 500 largest American companies, or in other words, S&P 500 ETF. So you have strategy, you are simply buying largest companies, and you know that you will be roughly making 10% per year in long term, and this is what you are buying. You are buying long-term performance, which could fluctuate in short term, but in 5 to 10 years, you will approximately know what you will make. Same goes with like government bonds or conservative corporate bond portfolio or ETF that follows these corporate bonds. So long-term, I would say predictable income with very little work. Besides the fact that you have to actually correctly structure your investment portfolio, know which are the best ETFs for you, what are the costs of your broker, and so forth. But once you have solved this question, in most time you don't have to do much. Simply invest in each month or each quarter a certain sum of money and let your capital grow. That's it. And then we have second bracket. Second bracket is what's called active investing. Active investing is approach where you are actively choosing your own investments. And in this approach, you have literally endless ways how to make or lose money, because here you are your own, I would say, boss. You could throw all your money and I would say get a loan from someone and put additional funds in one stock which you know nothing about, or you could work, I don't know, with multiple strategies in multiple asset classes and make some decent returns. So there is as many ways as possible, but here's what I have to say. If you are doing active investing, make sure that you know strategy and know how that strategy makes money and know expected returns. Because if you won't, you probably will be way worse than if you are simply passively investing. And actually that's the truth for most investors, especially those who are not professional money managers. They're not investing, they are hearing some tip or some news about some stock. They buy this stock because it's hot, because it has been appreciating in its value recently, and guess what? Most likely that this stock is already overbought and it had a majority of its gains. So mostly they lose money, they get burned out, and they say investing is bad. So actually what happens in practice, they think that they are conservative long-term investors, but actually they are rather bad traders, because they are going for quick profits, and if they don't have quick profits, they are still managing their long-term losing positions, and this is no way to trade or invest in that matter. So before you start, understand that you have to have correct investing strategy, which will tell you how to pick stocks, how to value stocks, how to create your portfolio, and how to adjust your portfolio. And once you have this in mind, then you compare this performance to general stock market index. And if that active investing strategy yields more results, significantly more, I would say higher results than S&P 500 strategy, you might have something. If you don't, do not do that. So I would say these are the two ways how to invest. And actually, before you start, then you have to assess these things. Who you are, what's your capital, what are your investing goals, what are your money resources and time resources, and then you have to assess whether you are a passive investor, which will do his homework from beginning, create your brokerage account, I would now pick some ETFs which will follow largest corporate bonds and stock market indices, and maybe some commodities. Maybe you will be creating your own investment portfolio, or you want to trade on price fluctuations. If you understand that, you have to have good either investing or trading strategies. If you don't have those investing or trading strategies, simply invest passively, you will be better off than 90% of investors. And maybe you could have third scenario where you have like most of your capital in passive investing strategies, and then allocate some sums to your own thoughts and your own ideas. And if you see that your ideas about investing or trading are working really well, then you could slowly add more capital to your own strategies. And I would say if most people will follow this guide and they will have patience and discipline to, I would say, let compounding interest grow, they will make money. But that's life, and life is full of ironies, and most people are not going to do that. I don't know why, but it's the way the world works. So to conclude, this is my way how I see investing. Firstly, I would say do not overstress whether you are investing or not according to classical definition, because no one is focused on the fact that you want to make money in financial markets. And if you want to make money in financial markets, firstly, assess yourself, your strengths, your time resources, your knowledge in financial markets, your money resources, and your ability to actually do something. If you don't have that much time to spend in financial markets, do passive investing strategies and have a benchmark to like 8 to 10% per year. It's easily reachable. All you have to have is good ETFs, good broker, and patience. If you want to have something more, please create either good stock picking strategy or good trading strategy. Then test it, see how are these results going with small amounts of capital. And if something is going, then only then allocate money to something else. So do this and you will be better off. If you won't, you probably will lose money. So this is my theoretical video about investing. I think it's worthily that I am doing this kind of theoretical or slightly more vague discussions about markets from time to time, because in investing it's not all about technicalities and ability to analyze markets. In most part is an ability to understand broad investing principles and understand your own goals in financial markets. So thanks for watching, and let's meet a bit later in my next video.